Ever stop to think how many companies out there rely on stuff they don't even own?
Like all those delivery trucks we see on the roads every day.
Yeah, exactly. Or the
Yeah.
machines keeping a factory running. Heck, even the very buildings businesses operate from. Leasing, it's kind of a big deal, right?
Absolutely. It's woven into the fabric of so many industries. But what's interesting is, for a long time, how those leases were accounted for, well, let's just say it didn't always give the clearest picture of a company's financial commitments.
So we're talking about potentially significant financial obligations that weren't exactly front and center in their financial reports. That seems kind of problematic, doesn't it?
It can be. If key financial obligations are tucked away, it makes it tougher to assess a company's true financial position. And that's where our deep dive comes in today. We're tackling IFRS 16 leases. Now, I know, accounting standards might not sound like the most thrilling topic,
Not usually the stuff at dinner party conversations, right?
but bear with me. This isn't just about bean counting, not at all. IFRS 16 represents a pretty major shift in how companies report their assets and liabilities connected to those leases. It actually has tangible effects on how businesses are perceived financially, in the real world.
So this is way more significant than just rearranging numbers behind the scenes. We're talking about changing how we understand a company's financial health.
Exactly. And to really wrap our heads around this, we've got a whole spread of materials in front of us. We've got the official IFRS 16 documents, of course, and analyses of its impact on those all-important financial statements. We've even got insights from some big-name accounting firms on how it's actually being applied out there in the wild.
So our mission, if you will, is to cut through the technical jargon and really get to the heart of what matters. We want to equip you with a solid understanding of IFRS 16's core principles and, most importantly, why it should matter to anyone who's, looking into companies' financials. No need to drown in accounting speak here. We'll keep it nice and accessible. So let's jump right in. What would you say is the single biggest change IFRS 16 brought about for companies that lease assets?
Well, the most significant impact is definitely on the lessees, the companies doing the leasing. The previous standard, IAS 17, it drew a distinction between operating leases and finance leases. Now, finance leases, they were viewed as essentially transferring the risks and rewards of ownership, right?
Because they were so similar to actually owning the asset.
Exactly. So they were recorded on the balance sheet, both as assets and liabilities. Operating leases, on the other hand, those were largely kept off the balance sheet, and the payments were just expensed as they happened.
Oh, yeah. I remember hearing about off-balance sheet financing. It always sounded a bit like, well, a way to make those debt figures look a little smaller than they really were.
You're not wrong. And IFRS 16 has essentially done away with this distinction for lessees, though there are a few specific exceptions, which we'll get to later. Now, for most leases, companies are required to recognize a right-of-use asset. Think of it as their right to actually use the leased item, and a corresponding lease liability, which is their obligation to make those lease payments. And both of these go directly on their balance sheet.
So instead of just kind of tucking away those lease obligations, companies now have to acknowledge them right there on their balance sheet. That's got to make a difference in how their financial position looks. Got an example to help illustrate this change, make it a bit more concrete?
Sure, let's imagine a nonprofit, maybe a community transport organization. They enter into a 5-year agreement for, say, 10 vehicles.
Okay, they need those vehicles to actually provide their transport services.
Right. And the contract specifies these particular 10 vehicles. It's very clear. The transport company, they get to decide all the routes, they set the fares, even who qualifies for discounts. And when those vehicles aren't out there on the roads, they're parked at the transport company's depot. The leasing company can't just, swoop in and take them back unless there's a problem with payments. Even if a vehicle needs maintenance, the leasing company has to provide a temporary replacement, same type of vehicle, the whole works.
So even though they don't own the vehicles in the traditional sense, the transport company has real control over how they're used and gets pretty much all the benefit from them.
Exactly. Under IFRS 16, because those specific assets, those 10 vehicles, are clearly identified and the transport company has that control over how they're used, they would recognize an asset representing their right to use those vehicles and a liability for the payments, both on their balance sheet. IFRS 16, it's basically saying, hey, you might be renting these assets, but you got to acknowledge them like you would if you owned them.
Okay, so it's about reflecting the economic reality of the situation. Now, just to highlight the contrast, how would this exact scenario have been treated under the old IAS 17 rules?
Under IAS 17, this would likely have been an operating lease. So the transport company would simply record those lease payments as an expense in their income statement over those 5 years, probably spread out evenly. The 10 vehicles themselves and the big financial commitment they represent wouldn't be clearly visible on the balance sheet. Like a 5-year lease for an office space. Under IAS 17, it was just a monthly rent expense. Now, with IFRS 16, that same lease results in a pretty substantial asset and liability right there on the balance sheet.
Ah, okay, that really clarifies how things have changed. So how does IFRS 16 actually define a lease? What are the key things that make a contract fall under these new rules?
The core definition is pretty straightforward. It's a contract that gives someone the right to use an identified asset for a certain period of time in exchange for payment, which they call consideration in the standard.
That identified asset part seems pretty crucial. What makes an asset identified under IFRS 16?
Well, it can be explicitly named in the contract, like our 10 vehicles, but it can also be implicitly defined, not directly spelled out. For example, a company might have the exclusive right to use a specific, physically distinct part of a large warehouse.
So it's like their own dedicated section within the bigger space.
Exactly. That would be an identified asset. Or if a company has the right to, let's say, almost all the capacity of an asset, like a significant portion of a pipeline's throughput, that could qualify too. It's not always about having a specific serial number. It's about having control over a particular resource,
Oh. Okay, so it's about more than just pointing to a piece of equipment and saying, that's the one. And speaking of control, you mentioned that earlier. What does having control mean in the context of IFRS 16?
Control means the lessee, the one leasing, has two key rights. First, they have the right to obtain substantially all the economic benefits from using the asset. And second, they have the right to direct how and for what purpose the asset is used, you see.
Substantially all economic benefits, that still feels a bit, I don't know, open to interpretation. What does that actually look like in real-world situations?
Yeah, it can be a bit tricky, which is why there's extra guidance in the standard. Think about, let's say, a power purchase agreement. A utility company agrees to buy all the electricity generated by a brand new solar farm for the next 20 years.
Okay,
Uh-huh.
so they're not building or owning the solar farm, but they're buying all the power it generates.
Right. Now, the company that actually owns the solar farm, they might get tax benefits and all that. But the utility company, they receive all the electricity, which is the main economic output, right? And they might even get renewable energy credits for using that green energy. So even though they don't hold the legal title, their right to all that electricity and those potential credits, well, it could suggest that they're the ones getting substantially all the economic benefits from the solar farm.
It's interesting. So even if you don't own it, the benefits you reap can point towards a lease situation. What about that other part of control, the right to direct the use?
That means the lessee has the power to decide how and for what purpose the asset is used throughout the entire lease. Or even if those decisions were mostly made when the lease started, if the lessee had a big say in those initial decisions, or if they actually operate the asset themselves, or if they design it specifically for their needs, these things can indicate they have that right to direct its use.
Okay, it all comes back to who's really calling the shots on how the asset is used. Now, are there any situations where an asset might seem identified at first glance, but the whole arrangement wouldn't actually be a lease under IFRS 16?
Yes, absolutely. One important exception is if there are what they call substantive supplier substitution rights.
Okay, that sounds a bit complicated.
Essentially, it means that the supplier, the one providing the asset, has the practical ability to replace the asset with a different one, and they would actually benefit financially from doing so. In that case, the customer, the one using the asset, doesn't really have control over a truly identified asset.
It's like they can't be sure they'll have that exact piece of equipment for the whole lease.
Exactly. Imagine a logistics company, right? They contract to use a specific model of truck from a big rental fleet. Now, if that rental company has tons of identical trucks ready to go and could swap out the original truck at any time, maybe to optimize their fleet or whatever, well, the logistics company might not have a lease of that specific truck under IFRS 16. It's all about whether the customer can depend on using that particular asset.
Makes sense. So you figured out that a contract is a lease according to IFRS 16. How do you actually record that in the financial statements at the start of the lease?
That's where we get to what they call initial recognition and measurement. So on the day the lease begins, the lessee recognizes the right-of-use asset at its cost. And this isn't just about the first lease payment you make, it's a much more comprehensive calculation.
So what all goes into this cost figure?
Well, it includes the initial amount of the lease liability, which they also have to recognize, of course. Plus, any upfront costs the lessee incurs to set up the lease, things like legal fees specifically tied to that lease. And if they made any lease payments before the lease actually started, those get added in too. And even an initial estimate of any costs to dismantle or restore the asset at the end of the lease, if that's part of the deal.
Wow, so it's a really thorough calculation of the initial investment, both upfront cash and those future obligations. Okay, what about the other side of the equation, the lease liability? How do they figure that out at the beginning?
The lease liability is initially measured at the present value of all those future lease payments the lessee will have to make over the entire lease term. This means you have to take each of those future payments and discount it back to its present day value using a specific discount rate. Think of it like, how much money would I need to invest today at a certain interest rate to have enough to cover all those lease payments down the road?
Ah, okay, bringing the future costs back to today's dollars. And what interest rate do you use for that present value calculation?
Ideally, you'd use the interest rate that's built into the lease, what they call the implicit interest rate. This is the rate that balances everything out. It makes the present value of those lease payments and any unguaranteed residual value match up with the fair value of the asset itself, plus any initial direct costs the lessor, the one leasing out the asset, had. But honestly, a lot of times that implicit rate is hard for the lessee to figure out.
So what do they do then?
They use what's called their incremental borrowing rate. It's
Yeah.
basically the interest rate they would have to pay if they went out and borrowed money to buy a similar asset. They're using their own cost of borrowing as the best estimate, which makes sense from a practical standpoint.
Yeah, it reflects their own creditworthiness.
Yeah.
So when you're calculating the present value of those future lease payments, what exactly counts as a lease payment?
Lease payments include those regular fixed payments, and that also covers what they call in-substance fixed payments. Those are payments that might technically vary a little, but they're pretty much unavoidable. Like if a lease has a minimum payment amount that's almost always exceeded, you see.
Ah, so it's not just about the label, it's about the economic reality.
Exactly. You also include variable payments that are linked to an index or a rate, like payments tied to inflation or a market interest rate. And if there's an option for the lessee to buy the asset at the end of the lease, and it's pretty certain they'll do that, then the purchase price is included as a lease payment too. Same thing, if the lease term considers them exercising an option to terminate the lease early, any penalties they'd have to pay for that are also part of the lease payments.
What about things like maintenance or insurance costs that might be bundled into the lease agreement? Do those count as lease payments?
Payments that are specifically for non-lease components, like maintenance or insurance services, those are usually excluded from the lease payments unless the lessee chooses to use a practical expedient to simplify things. So like if you have an office lease and part of the rent covers utilities, ideally you'd try to separate that out if it's priced separately.
Okay, so you're breaking it down into the pure lease cost and any additional services.
Right. But they do have the option to just treat the whole payment as relating to the lease of the office space. And any lease incentives, like a period of free rent, that reduces the overall cost of the right of use asset.
Got it. So you've got your initial right of use asset and lease liability on balance sheet. How do you account for these in the periods after the lease starts?
That's where subsequent measurement comes in. The right of use asset, you typically depreciate that over the shorter of the lease term or the asset's useful life, how long it's economically viable.
So it's like recognizing the gradual decline in the value of that right to use the asset.
Yes, exactly. The depreciation method should reflect how the lessee consumes the asset's benefits. Many times, it ends up being straight-line depreciation, meaning they recognize the same amount of depreciation expense each period.
And what about the lease liability? Does that just stay at its initial present value?
Nope, the lease liability changes over time. You increase its carrying amount to reflect the interest that accrues on the outstanding balance, just like a loan, and you decrease it as the lessee makes those lease payments. So every period you recognize interest expense, it's basically unwinding that discount you applied at the beginning.
Ah, so it's like gradually paying down a loan over time. What happens if there are changes to the lease agreement while it's still in effect? Like if the lease term gets extended or the rent goes up because of some index-linked clause?
Those kinds of changes trigger what's called a remeasurement of the lease liability. So if the lease term changes, maybe the lessee decides to use that extension option they weren't sure about before, or if there's a change in the amount they're expected to pay under a residual value guarantee, or if those future payments change because of some index or rate fluctuation, they've got to recalculate that lease liability.
So it's not just about updating the payment schedule in your accounting system. It's about reflecting those changes in the overall liability.
Absolutely. And when they remeasure the lease liability, they make a corresponding adjustment to the carrying amount of the right-of-use asset. The asset and liability are tied together. They have to be adjusted together to reflect any changes in the lease agreement or the underlying economics.
Okay, it's like keeping those two sides of the equation in sync. Now, earlier you mentioned some exceptions to this full-blown balance sheet recognition. Can you remind us what those key exemptions are?
Yes, of course. One is all about how you determine the lease term. This isn't always just the initial non-cancelable period written in the contract. It also includes any periods covered by options to extend or terminate the lease if the lessee is reasonably certain they'll either exercise or not exercise those options.
So you're looking beyond the legal contract to the likely economic reality.
Exactly. Let's say you have a retail company. They lease a store location for 5 years with the option to extend for another 5. Right at the start, they have to figure out if they're reasonably certain they'll take that extension. Things like significant improvements they made to the store, the importance of that location to their business, how well that store has performed in the past, all those things might suggest they're probably going to extend, even if they haven't formally told the lessor.
So it's about making a judgment call based on the available information.
Right, but then let's say their business in that area starts declining. That might change their whole thinking about extending, and they might have to reassess that lease term.
It shows how important that initial assessment and any later reassessments can be. What are those other exemptions you mentioned?
There are exemptions for short-term leases and leases of low-value assets. Short-term leases, those are leases with a term of 12 months or less from the start date. Lessees have the choice to not recognize a right-of-use asset and a lease liability for these. They can simply expense those lease payments over the lease term, kind of like how operating leases were treated under the old rules.
So it's like a simplified approach for those shorter leases?
Yeah, it's a practical option. And the other exemption is for leases of low-value assets. IFRS 16 doesn't give a hard dollar figure for what's considered low value, but they give examples like small IT equipment, things like tablets and PCs, or inexpensive office furniture. They suggest an asset worth around 5,000 US dollars or less when new might be considered low value. And this exemption, you can apply it on a lease-by-lease basis.
So if a company leases 10 laptops, each costing $800 new, they could choose to use that exemption for each individual laptop.
That's the idea. It's meant to make things easier for lease agreements that involve assets that aren't really a big deal to the company's overall finances. Remember that practical expedient we talked about earlier? It's not an exemption, but it's another way to simplify things. It lets lessees lump together lease and non-lease parts of a contract and account for them as one big lease component. Like, if an office lease includes stuff like common area maintenance or utilities, they might find it easier to treat the whole payment as a lease payment instead of trying to separate out the cost of those extra services.
So it's all about making life a bit easier for the accountants, right?
To a degree, yeah. But it also aims to provide a faithful representation of the lease arrangement in the financial statements. Now, we've talked a lot about how IFRS 16 impacts lessees. What about the lessors, the companies leasing out those assets? Does IFRS 16 shake things up for them too?
Good question. I'm curious about that as well.
Well, the accounting treatment for lessors is pretty much the same as under the old IAS 17. They still categorize leases as either operating leases or finance leases, based on whether those risks and rewards of ownership are mostly transferred to the lessee.
So no major changes on the lesser side.
Not really. For operating leases, the lessor keeps the asset on their balance sheet and recognizes lease income over the lease term, usually in a straight-line fashion. For finance leases, they take the asset off their balance sheet, recognize a net investment in the lease, which is basically a lease receivable, and recognize interest income over the lease term.
Makes sense. So the big changes and challenges are really on the lessee's side.
That's right. Now, when companies first adopted IFRS 16, did they have to completely rewrite their accounting history, or were there some, transition options?
I'd imagine that applying these new rules retrospectively could be quite a headache.
Yeah, it could. Companies had a choice. They could apply IFRS 16 retrospectively, meaning they'd have to restate their past financial statements as if the new rules had always been there. Or they could use what's called a modified retrospective approach.
So that sounds a bit gentler.
Yeah, it was meant to be a bit easier to manage. They didn't have to restate those comparative periods. Instead, they recognized the overall effect of adopting IFRS 16 as an adjustment to their opening retained earnings at the date they first applied it.
So they basically adjusted their starting point to reflect the new rules.
Right, and with that modified retrospective approach, they had some practical expedients to simplify things even further. They didn't have to reassess every single old contract to see if it contained a lease under the new definition. They could use one discount rate for a bunch of similar leases. They could even rely on their previous assessments of whether a lease would have been considered burdensome under IS 37.
Sounds like they tried to make the transition as smooth as possible.
Yeah.
So, to sum it all up, what's the one key takeaway about IFRS 16 that everyone should remember?
The big picture is this. IFRS 16 has brought most lease obligations out into the open, onto the balance sheet for lessees. This gives us a much clearer and more complete view of a company's financial obligations and the assets they control through leasing.
It's about transparency, isn't it?
Yes, it is. The specific rules can be detailed, but the main idea is to show the economic reality of those leases. It's about the right to use an asset and the obligation to pay for that right.
Well said. So, here's something to ponder. Think about a company you're familiar with, maybe one you invest in or one in an industry you follow closely, and imagine they lease a lot of their assets. How might adopting IFRS 16 have changed their balance sheet? How might investors see their financial health differently now? What new questions would you want to ask when you're looking at their financials?
And if you're really keen to dig deeper, take a look at the financial statements of some publicly traded companies. See how they're presenting their leases under IFRS 16. Those notes to the financial statements, those are often a goldmine of information about their leasing activities, the types of assets they lease, the terms of their agreements, all that good stuff. You could also look at industries that rely heavily on leasing, like airlines, retail, or logistics, and see how IFRS 16 has impacted their financial reporting.
That's great advice. It's all about understanding the nuances, isn't it?
Exactly. IFRS 16, it might seem like an accounting technicality, but it's actually changed the landscape of financial reporting. And understanding its impact can give you a real edge in analyzing a company's financial position.
Thanks so much for taking this deep dive with me. Until next time.